The most dangerous moment in any financial bubble isn't the crash. It's the moment when doubt disappears. That's the moment when prices are rising, confidence feels justified, and skepticism starts to sound ignorant. Not reckless, not irresponsible, just outdated. By the time the word bubble enters everyday conversation, the real work has already been done, not by fraud or conspiracy, but by the human mind quietly convincing itself that this time is different. Welcome to The Financial Historian, where money, power, and history collide. And nothing is ever as simple as it looks. Every major financial bubble in history shares a strange trait. When it's happening, it never feels irrational. It feels reasonable, responsible, even. Participants don't believe they're respeculating, they believe they're readapting to a new reality. And that's why bubbles are so hard to see from the inside. They don't announce themselves as success, they present themselves as progress. This pattern isn't modern. It's ancient. Long before stock tickers and venture capital, humans were forming speculative manias around assets that seemed to promise a radically different future. Tulips in 17th century Holland were prodigious flowers. They were status, rarity, and a new market structure. Railroads in the 19th century weren't just steel and steam, they were national destiny. Radio stalks in the 1920s weren't just companies, they were the sound of the future. The internet in the 1990s wasn't just technology, it was the end of distance itself. Each of these innovations was real. That's important. Bubbles are not built on fiction, they're built on truth, stretched beyond its breaking point. The psychology that drives this process is remarkably consistent, and it begins with something deeply human. Our need for stories. Humans do not make sense of the world through spreadsheets. We make sense of it through narratives. A story explains cause and effect. It assigns meaning. It reduces uncertainty. And when a compelling story attaches itself to an emerging technology or asset, it becomes extraordinarily powerful. The numbers don't lead the belief. The belief leads the numbers. Once a story takes hold, valuation stops being the starting point. It becomes an afterthought. Traditional metrics are waved away as irrelevant, relics of a world that no longer exists. Profitability isn't dismissed outright. It's postponed. Losses aren't seen as warning signs. They're framed as investments in inevitable dominance. When a story feels true enough, math becomes a nuisance. This is where social proof enters the picture. In uncertain environments, humans instinctively look sideways. If others are buying, it feels safer to buy. If respected peers are confident, doubt begins to feel unnecessary. Markets amplify this instinct because rising prices themselves become evidence. Every increase in valuation reinforces the belief that the story must be right. Otherwise, why would so many people agree? Over time, skepticism becomes socially expensive. Analysts who question valuations are labeled pessimists. Investors who stay on the sidelines feel left behind. Career risk starts to outweigh financial risk. It becomes easier to be wrong with the crowd than right alone. Consensus doesn't feel like herd behavior when you're inside it. It feels like confirmation. Once consensus forms, confirmation bias takes over. Investors don't stop looking at data. They just stop looking at inconvenient data. Positive signals are highlighted, shared, and repeated. Negative indicators are reframed, contextualized, or dismissed as noise. Valuation models are adjusted. Definitions are softened. Words like temporary, transitional, and long-term begin to do heavy lifting. This is the phase where bubbles become self-sealing. Any information that contradicts the dominant narrative is interpreted not as a warning, but as evidence that the critic simply doesn't understand the new paradigm. Then comes overconfidence, the quiet kind. Rising markets reward participation. Early success feels personal. Gains are attributed to insight, timing, and intelligence rather than conditions. New investors believe they've discovered a unique opportunity. Experienced investors believe they've learned how to manage risk better this time. Everyone believes they'll exit before the collapse, even though history shows almost no one does. Luck feels exactly like intelligence, until it doesn't. Authority bias adds the final layer of psychological armor. When major institutions validate the narrative through participation, doubt collapses entirely. Large banks issue bullish reports. Governments celebrate innovation. Central banks maintain supportive conditions. Capital flows freely. At that point, the asset stops feeling speculative. It starts feeling endorsed. Nothing says stable system like needing institutional reassurance to maintain confidence. And here's the cruel part. None of this feels reckless while it's happening. It feels like alignment, like progress, like inevitability. Prices rise, confidence grows, and caution fades. Not because people stop thinking, but because thinking becomes emotionally inconvenient. This is why bubbles are so rarely recognized in real time. They don't feel like madness. They feel like consensus catching up to reality. But consensus has a blind spot. It can't see the assumption holding everything together. By the time a bubble becomes visible, it already feels normal. That's the paradox. The psychology that creates bubbles doesn't announce excess. It anesthetizes it. Prices rising stop feeling like a signal and start feeling like background noise. Volatility becomes familiar. Risk becomes abstract. And eventually, the question stops being, is this sustainable? And becomes, how do I avoid being left behind? This is where modern bubbles differ from the caricature we imagine. They don't require mass hysteria. They don't need day traders quitting their jobs or taxi drivers giving stock tips. Today, bubbles can form quietly, driven by institutions, indexes, and capital concentration, with very few people actively questioning the underlying assumptions. Which brings us to the present. Right now, a growing number of investors are asking whether we're re-witnessing the early stages of an artificial intelligence bubble. Not because AI is fake, it isn't, but because expectations around it are expanding faster than the underlying economics can currently justify. This distinction matters. Every major bubble in history was built on something real. Railroads transformed transportation. Electricity reshaped industry. The internet changed communication forever. The dot-com bubble didn't burst because the internet was useless. It burst because capital assumed immediate, universal, and perfectly monetizable adoption. AI follows the same pattern. The technology is real. The productivity gains are real. The long-term impact is likely enormous. But markets don't price long-term inevitability. They price short-term expectations. And that's where psychology re-enters the equation. In recent years, a small group of AI-linked companies has driven a disproportionate share of overall market gains. Index performance has become increasingly concentrated, meaning fewer firms are responsible for most of the upside. This concentration itself isn't proof of a bubble, but it is a familiar ingredient. When belief funnels capital into a narrow set of symbols, those symbols begin to carry narrative weight far beyond their financial statements. Valuations rise not just because of projected earnings, but because of assumed dominance. Margins that don't yet exist are priced as if they reign inevitably. Heavy capital expenditure is reframed as strategic necessity. Profitability becomes something that will arrive later, after scale, after market capture, after disruption finishes rewriting the rules. Sound familiar? This is where confirmation bias quietly does its work. Positive announcements are amplified. Adoption headlines are celebrated. Negative data points, rising costs, competitive pressure, regulatory friction are contextualized away. Skepticism isn't debated. It's dismissed as short-term thinking. At the same time, authority bias strengthens the narrative. When major funds, index providers, and institutions allocate heavily toward the same theme, belief solidifies. Participation itself becomes validation. The question stops being, what is this worth? And becomes, how exposed am I if this keeps running? This is the psychological shift that defines the late stage of belief formation. Not panic, not mania, just quiet alignment. And here's the uncomfortable truth. None of this requires bad intentions. Most participants aren't reckless. They're rational, responding to incentives, benchmarks, and career risk. When underperformance carries professional consequences, staying cautious becomes more dangerous than staying invested. This is how bubbles can inflate without widespread enthusiasm. They don't need excitement. They need compliance. The mistake people make is assuming bubbles pop because everyone suddenly realizes they were wrong. It almost never happens. Bubbles burst because one assumption breaks. It might be revenue growth slowing. It might be costs rising faster than expected. It might be a shift in interest rates that forces capital to reprice risk. Whatever it is, the moment the core narrative loses coherence, psychology reverses direction. Confidence doesn't fade gradually. It snaps, and when it does, the same forces that drove prices upward accelerate the decline. Social proof flips. Confirmation bias hunts for bad news. Overconfidence evaporates. Authority retreats. Liquidity dries up. What once felt inevitable suddenly feels fragile. This is why bubbles feel obvious in hindsight and invisible in real time. So how do you protect yourself? Not by predicting crashes. History shows that timing bubbles is nearly impossible. The goal isn't foresight. It's the most important question is not, is this a bubble? It's what belief am I relying on? If growth slows, what breaks? If capital tightens, what changes? If expectations reset, what remains? When investment decisions are anchored to narratives rather than cash flows, timelines matter. When valuations depend on future perfection, patience becomes risk. And when everyone around you feels certain, that's when uncertainty deserves the most respect. History doesn't repeat because assets change. It repeats because psychology doesn't. Bubbles don't form because people are greedy or stupid. They form because belief feels safer than doubt right up until it isn't. And the people who survive them aren't the ones who saw the future clearly. They're the ones who understood their own assumptions. That's the real lesson buried beneath every crash chart and postmortem headline. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.